Most traders lose money not because they have picked a bad stock, because entries have forced them to take a bad risk. In this video, I will show you how I think about precise swing trading entries where the risk is small but reward could be meaningful. Hey everyone, my name is Gaurav and welcome back to my channel. If you search swing trading on YouTube today, you will find tens of thousands of videos. Your indicator, strategy, processes, setups, everything is out there. Yet 99% people fail to be profitable in swing trading. And clearly the problem is not the lack of information. And I will tell you exactly what the problem is. Swing trading has three main components. The first one is setup, second one is risk management, and third one is psychology or mindset. People are obsessed with setups. Why? Because it's quite easy to consume, easy to copy, easy to blame. But when it comes to psychology or position size, they'll pay very less attention. If your mindset is not calm, if you don't think in probabilities, if you don't think in terms of series of trade, you are bound to lose in this market and no perfect entries or setup will help you. So yes, today we'll talk about setups and entries and everything, but you be mindful that if you're not going to fix your mindset and position size component of this entire trading framework, this video will have a zero impact on your learning curve. So there are two main broad ways to make money in stock market. One is you identify a stock and hold it for multiple quarters and let the stock run for 200, 300, 400% kind of return. And that's what I call as a core. The second approach is hunting multiple winners, targeting let's say 10 to 30% kind of return and compounding portfolio by actively rotating money into those stocks. And that I call as a satellite or swing. Now, if you want to catch a 200, 3%, 100% kind of return, then in that case, you have to go through a lot of consolidations and pullbacks. And sometimes those consolidation and pullback can fail and the stock can go to stage 4. Hence, whatever the profit you made, you might lose those profits. But then if you are capturing 15-20% quick return in let's say a few days, 5 or 10 days, and you sold that a stock and stock went on to become 3x 4x, then that is also not good, right? And that is why I'm a big proponent of having a core and satellite portfolio. The first probably 60 to 70% you can allocate in core, and then rest of them you can play with satellite or swing trading. This is the core framework which I operate with for in swing trading. First is scanning. Okay, so identifying the stock, which I've already discussed in this video. The second one is anticipation, which means you're looking for the setups which basically suits you. Third one is your entry, where you time your entry. Fourth is your exit or stop loss. Fifth is your risk management, which include position sizing. And the last one is your journaling. Today we'll discuss about the second and third part of this entire framework, which is your anticipation and your entries. With that, now let's go to the setups. Now this brings to my swing setup. The chart which you're seeing right now is my master swing setup. Exactly the same setup I trade 99% of the time, be it Indian market or US market. Now this is not an entry discussion. This is more about recognizing the setups and understanding how the ideal setup look like. So in weekend, if you're sitting and doing a quick 50-60 names scanning, what exactly you are looking for, what exactly your eyes are looking for, that's what this chart tells you. The first and foremost step is your prior trend, right? So if you see on the left side of the chart, you see a decent good move here. So ideally we want to see a prior uptrend of 30% or above, right? Higher the better. And basically these uptrend is nothing but a formation of higher high and higher lows, right? Now, why this uptrend matters? Because it generally tells that institutions and are accumulating in this zone, and we are wanted to be a part of those kind of stock where decent accumulations are happening. Once the prior uptrend is done, we want to see a contraction phase. We want to see the stock entering into the contraction phase. So after the uptrend, price does not immediately collapse; it goes into sideways. Okay, so it enter into the contraction phase, and this contraction phase generally lasts from 3 days to 20 trading days. Now this is a generic number I have given. 3 days the minimum, and around 20 to 25 days is something we want to see, which is approximately 4 to 5 weeks of consolidation. Now during this phase, price moves sideways and is slightly pull back, right? And candles become very narrower. So the more this particular consolidation moves to the right side of the base, we see a lot of supply is already being absorbed, and hence a massive contraction happening on the right side of the base versus the left side of the base, because here the supply is very high. Lot of participants want to dump their stock, and hence the swings are a little wild. But more we move towards the right side of the base, we want that supply to be absorbed, and hence the move to be as low as possible. We want this move to happen in very orderly and very calm manner. We don't want to see very wild swings here on the right side of the base. If that is happening, it means there is still some supply left that could hit our stop very quickly, because we are entering into a very narrow, we are very small stop loss, so that could hit our stop loss immediately. Now, one part I want to discuss, because most of the people do ask me about the moving averages. So the one which I like most is the 21 DMA. So my consolidation, my entry, and my exit all generally happen with 20 DMA, 21 DMA, right? Or maybe around 21 DMA. But it doesn't mean that all the consolidation will form around the same price, EMA. I would prefer if it happens around 21 DMA. But stock doesn't know what the EMA is, right? So anything between 11 EMA and 51 EMA, I'm happy to be a part of. Above 11 EMA is basically extended, and below 51 EMA, I find it nothing could happen, below 51 EMA. So any consolidation happening between 11 and between 51 EMA is something ideal zone for us. Okay, along with that, here I have not highlighted the volume, but we want to see the volume contraction also in this phase. So when the phase is declining, your inside bar narrow range is forming over here. We want to see a pocket pivots occurring here, so we want to see a lot of accumulation by the institution happening over here in the volume side, and also we want to see a tight contraction in the volume also. Basically, no aggressive selling pressure should be there. Okay, and there are two entry points that you see here, but I'll discuss about these entry points in a bit. Before that, I'll just quickly talk about the context. See, one thing is very important for you to understand is this setup will occur in almost every market and almost every day, every point of time, right? But you cannot initiate your position all the time. You have to have some kind of context behind this setup, which means this setup alone will never matter unless these context aligns. So for example, your weekly trend should be uptrend, right? So that is one context, right? So if on daily chart, if I'm looking the setup, uh, the setup alone doesn't make sense until unless weekly trend is uptrend. If weekly trend is, let's say, 5 month downtrend, and then suddenly due to some recent tailwind or something, the stock made this kind of setup, I'm not too interested. I want the trend of weekly to be uptrend, right? Secondly, your market trend, right? So if market is choppy or market is downtrend and this setup is forming, but I might not initiate the position because again, this context is not clean here. The third one, which I generally look for, the strong sector. If there is a stock which is making this kind of setup, but there is another stock where a lot of sectoral tailwind is there, I would prefer to be a part of that. And the last one, which I look for, a fundamental or some earning push behind the move, or behind the setup. This is also one of the factor which will increase your hit rate or strike rate. Putting a context behind your setup. Don't look the setup or the chart pattern all alone. Look the context behind it, why the setup has formed. Maybe the sectoral tailwind, maybe the market is working well, weekly trend is up, and earning a fundamental push is there behind the setup. Those kind of context matter. Now if you see here, there are two entry point I've highlighted. One entry point is here, entry point 1, entry point 2. Now entry point 1 is basically where this kind of pattern is forming. It could be VCP, cup and handle, flag, it doesn't matter. Basically I want to see the right side of the wedge being formed and very narrow range inside candle here, NR4, NR5, NR7 kind of candles being formed here. Now this could be entry point 1, right? So where the base breakout happened and we entered it. But sometimes we tend to miss this entry due to a number of reasons. So the second ideal entry point would be after the breakout, the pullback. The first pullback which you see, that could be your ideal entry point. And then maybe if stock further forms a lot of pullbacks, clean pullbacks like Cupid, right? Perfect example. Then of course you can have your entry point. But these two are the two ideal entry point where you either enter within the base before the breakout, not during the breakout, before the breakout. And then second ideal entry point would be once the breakout happened and stock moved let's say 20-30%, and then it starting to do a pullback around 11 or 21 EMA. Then that could be our next ideal entry point. So in a nutshell, this entire phase is about recognition, not execution. So if you learn to identify these structure consistently, entries become rule based, not emotion. Okay, with this, let's go to the next stage, which is entry point. Now, this chart shows three different entry scenarios on the same structure. Okay, and all three entries are valid. Okay, so the entry point which I'll discuss now are not, none of them are right or none of them are wrong. You have to define your own entry point depending upon your situation, and I'll discuss about those in detail, right? So what is the structure? Structure is quite simple. There's a prior uptrend, right? And then you found a big base, big consolidation happening, and then it's basically cup and handle. So cup formation and then the handle a little bit drifting, the range formation happening, and then the breakout happened, right? Now let's go into the first one, which is your anticipation entry, zone one, right? So the entry which you see in the white line, around 436, right? That is our first entry. This entry comes during the tight contraction inside the base. So within the base, you see the tight contraction happening of few candles, probably a range of probably in a range of three or four, right? This is where the entry happen, right? But before I go into the entry details and everything, let me just quickly discuss what this anticipation entry means, right? Anticipation entry is basically entering before the breakout of the range based on the structure. This entry have high failure rate. I mean, it has very low strike rate, right? Or hit rate, probably 30-35%, best case scenario, but it's very rewarding. So if you get a even 4 or 5 entries in a year, right, it will give you a massive reward. So anticipation entry is only for advanced trader, which I mean is, the one who have zero hesitation to cut their stop loss. These kind of entries suits them, right? They always think in probabilities. They don't worry about strike rate or win rate. They're more worried about risk and reward. They are very good in cutting their losses, and they don't expect all their trade to be winner trade, right? They're happy to have a lot of multiple losing streaks, but they know even 1 or 2 or 3 trades will cover everything else, right? So those kind of traders who is mentally very much mature and they have a decent edge, those kind of trader has a very good advantage or benefit to using this anticipation trade. So in this example, your entry zone one, right? So here the tight contraction on IB bar, inside bar you have entered, right? So ideal entry point for me was this IB bar. So this bar which you see here, it had hardly a stop loss of 2%, I think 1 point some percent. But let's say we have a stop loss of 3%. So here the reward was 41%. So your RR would be around 13.5 RR, right? Risk reward ratio. Now in this case, your only problem is low win rate, but it demand extreme high discipline. But then reward is massive, right? If with this 2 or 3% of a stop loss, even if you have a 10 losing streak, probably couple of good trades will recover everything else, right? So that kind of potential this entry zone has. Okay, so this summarizes your entry zone one, which has a massive risk reward but very low win rate. Hence, this suits only to those advanced traders who are very good in cutting their losses, and they don't mind, having a lot of losing streaks, because they understand you don't need to be right all the time. Now let's go to the entry point 2, which is entry zone 2, which is around 453 or 54, the green line which you see, right? Now this is the clean range breakout entry, right? And this is where I would suggest 90% or maybe 95% of trader can start timing their entries in this zone. So this happened when the price clearly breaks above the range high, right? After the contraction phase. So this was the, basically consolidation happening, then first leg up, and then a small range contraction happen. Your entry zone one was this inside bar without knowing that, breakout will happen or not. But your entry zone 2 is only happened when the breakout has happened from this zone. These three candles basically has one parent candle, this one. We entered when this parent candle broke out, so maybe around 454, 453, right? We simply put a line here, right click, put an alert, and when the alert got triggered, you immediately put your buy signal, or you put a GTT order, doesn't matter, but basically your entry happened here, okay, around 453. Now in this case, your reward is good, decent, so 36%, though low from your anticipation entry, which was 41%. And if I put a SL of, let's say, low of the candle, basically 4% of stop loss. In this case, my risk reward will be 9R approximately. And this is the best case scenario, right? So this is the best balance of probability and reward. The structure is visible here. right? And risk is pretty much defined because I know, my what will be my stop loss here, based on the range and everything else. And momentum confirms the move, right? So this momentum, because there is a upward momentum which basically confirms the move, whereas in anticipation you will have to wait for momentum, which we don't know. It might come in next 2 candle or maybe next 10 candle, right? So that is a problem with anticipation entry. But with the range breakout, you know that the range breakout has already happened, and there is a chance, a probability, that the stock will now move up. And this is the most rewarding entry zone, because it's basically give you a decent risk reward, uh, and also it has a little bit higher win rate versus the anticipation one, right? And I will show you a lot of examples about these entries, because majority of my entries happen at this range breakout. And some of the entries where I feel a little bit extra confident, I try to enter into the anticipation zone. And the third option is entry zone 3, which is the obvious breakout zone here. So the red line which you see here. So this is where the cup and handle. So very cup, and it's a drifting handle or wedge which is formed, and then the breakout happen. Maybe an entry around this candle, which is around 505, right? This is the most logical market entry, right? Because the most logical breakout, quite visible breakout happening there, and hence most market participants feel comfortable entering there or buying there, right? And it's not wrong, okay, nothing wrong is there. But because this already is very clear, and there will be a lot of crowd there, a lot of noise there, hence a lot of institutions and a lot of people use this zones for the stop loss hunting. So most of the time, if you see here, especially in the market is not healthy, or sometimes when even if the market is healthy, that's what I've experienced, sometimes a lot of choppiness or stop loss hunting happen here. Now for in this example here, the, let's say, SL is still 4%, right? But the reward is quite low here, because let's keep keeping the same target point. If I'm cutting at the same target point around 620, as it was in entry zone 1, entry zone 2, your reward will be now 21%. So hence your risk reward will come down to 5. Now, again, this is nothing wrong, as I said earlier, right? This is also one of the entry point. This is all three could be one possible entry point. The idea is which entry point suits you the most, or which entry point you are most confident with. If you are going with the zone one, it offers the maximum reward, of course, but the win rate would be quite low, right? So you should be, first of all, comfortable cutting in losses quickly, and secondly, you should be okay to have 30-40 kind of a strike rate. Now zone 2, which offers best probability or best reward balance. So this is something, I would suggest 90% trader out there to look for. And the third one is, psychologically, this is most comfortable zone to enter, but it reduces the edge. Now, before I move to the examples which I wanted to discuss, there is a one quote by Mark Douglas I wanted to share with you guys. Anything can happen. You don't need to know what's going to happen next to make money. Mark Douglas has made it very clear that real reward doesn't come from these smart entries, what we discussed. Reward to those traders who can survive long enough in the market so that those probabilities can work in their favor. And that's why more than entries, you need to put a lot of effort or understanding on risk management side of it. I am talking about this now because your entry should match to your temperament, because after you enter, market doesn't owe you anything, right? So once you have made the trade, the next candle, you really, nobody knows what it will be, right? It can go up, it can go down, it can go sideways, and only thing which is in our control is to control the stop loss, control the risk management, right? So as a trader, when I'm putting my x amount of money in a trade, I before that trade moves tomorrow, exactly know how much I'm going to lose it, and I should be okay with that mathematically. So that is why risk management is the most important bit of this entire trading framework, and I'll repeat this again and again. With this, let's go to the examples. Okay, now that we have defined the setup and three entry zones, zone 1, 2, 3, the only way to truly understand and master this entire setup is through live examples. So in this section, I will show you some pre-chart and post-chart, and some entries worked well, some entry failed, and this is intentional. So because none of these aspects work all the time, and that is the one key mental model you have to put in your brain, right? Before I start, just quickly to tell you the layout of my trading view. So the green line which you see is 11 EMA, and the black is 51 EMA. Okay, in the bottom is a relative strength, and then I see here the pocket pivot volume indicator by trader line, right? So the green one is shows the pocket pivot of 10 days, and the yellow one is of 5 days. Now, let's start with an example of JP Power. So JP Power, this is a pre-chart, a pre-entry, right? So this is before any breakout. No, structure is pretty much same. So you have a prior uptrend, right? From almost like 13, it went to 18, and then it did a small pullback around 11 daily EMA, and then moved up and formed a good contraction here. Now, because of a lot of pocket pivots of 5 days, this was my anticipation entry. So I entered around 18 dot something. In the next, now if you see the post chart, immediately after the breakout of the range, which is a 3 candle, the follow through happened, and this basically candle appeared. This was a little shaky candle, but entry could be done here. And after that, again, a small pullback at this EMA when it moved to its high, and the breakout happened. This was a good trade, positive trade, and it went up. How to sell, what to sell, don't worry about it now. I will make a detailed video about that too, and we'll discuss about position size, risk management, and exit in detail. So next example, I have Paradip. So when the agri companies was doing well in sometime in June, July, this was one candidate which was perfect to do a swing trade in. So this was my entry point basically. So it's clean again, uptrend, forming a perfect base, and when the base completed and forming a right side contraction of the base, if you see the volume in the down pretty much negligible, and suddenly you see 2 5 days pocket pivots. RS immediately changed. So relative strength I have not discussed too much today, but I will share those details later on. But RS also kind of going into positive direction and pretty much making a new high over here. And this was my entry point. So the inside bar and these three narrow ranges. So I took the parent bar as my entry point and pretty much draw my line, do the right click, alert. When the alert triggered, somewhere around 175, 176, my entry happened, right? This wasn't a great candle, but the next few days was good follow up. Then it did a good move from next 5 to 10 days, around 34%. App, it's again a US company. I'll just quickly show you from the concept point of view. Pretty much same repetition. So we are looking the prior uptrend, the base consolidation is happening. So one learning I just quickly want to highlight over here is if you see there is a prior uptrend, base formation is happening, good consolidation, and out of these three ranges which you've seen here, I would prefer this because this is closest to its previous high, the consolidation zone high, right? So that is why this is something more preferred. Now entry was simply the breakout of this particular range. It again immediately pulled back, but it never hit my SL. So it pulled back and it came back. It was good. This could be the second entry point. So if I go back to the next chart, so base formation, within the base entry, range formation, and then stock broke out, pulled back. One entry could be timed over here also, but I was not too confident about this entry because there were not any narrow range candle of three days or more, no inside bar, so that's why I was not confident. Hence I kind of entered in here, right? So, and after that the stock moved 86%. Okay, the next one I have BSC trade of last year. Those who follow me on X knows that they know that this was one of my most favorite trade last year. So again, the same stuff. We see the high uptrend, at least 30, 20, 30%, 30 more than 30% of move here, then forming a right hand side base, and then the entry was pretty much at the breakout of these three candle. This was my entry point. The one thing which I wanted to highlight over here is more than the structure of the chart, which is not too exciting. I was excited with the pocket pivot. So if you see in the bottom, there are a lot of pocket pivots, a cluster of pocket pivots happening on the right side of the base. It basically shows a lot of institutions are showing interest and they are kind of accumulating the stock. After that, the stock moved. After the entry point, it went down a little bit, but the stock moved, never hit my SL, and it went up almost 60-70%, and then later on I was able to capture 40%. Next was Cupid. So Cupid, I mean, I've already discussed in previous videos, but this is perfect swing trader, dream chart for swing traders. There are a lot of narrow ranges getting formed here. So first of all, this cup and handle, right? So that itself is a good entry point. Prior uptrend, good consolidation, good right side base formation. In the bottom, volume pretty much disappeared. There are few pocket pivots happening here, and once the breakout happen of this inside bar, you can make an entry. After that, then second entry point was here where small narrow range of three candle formed, or this one also, but I prefer a little bit more this one, where more than 3-4 candle narrow range formed, and then breakout happened. Then entry point 3, entry point 4, entry point 5, entry point 6. You can not all the entry point are pretty much as good as entry point 1 or entry point 2. They do not have all the characteristic which I have discussed earlier. Hence entry 1 and entry 2 would be the most ideal one. And there are a lot of pocket pivots here on the bottom, with that itself shows the strength. And RS was always making a 52-week high and making a new highs. So all these are the good signals and perfect dream chart to for any swing trader to study. These are the few examples which I wanted to show you how the live entry happens. Next important point which I want to talk about is stop loss. Now stop loss, I will definitely make a detailed video later on, but this is non-negotiable. Okay, as a swing trader, if you really want to grow in long term, your stop loss has to be there, and more important, execution of stop loss. The only reason I look for the tight entries because I want to look for a tight stop loss. So let's assume yesterday when I sat, I scanned my 50-60 charts, and after that I have identified 2 or 3 good candidates which look juicy to me because it has inside bars, it has an narrow range candle, prior uptrend, right side base consolidation near around 21 DMA and all those bits. Right now, today stock didn't move much. It again formed one more inside candle or a narrow range candle. Right, what I generally do is, if that stock is very good, contextually and everything, I will do my, let's say, if I want to allocate 20% in a stock, I will start with 5%. So 5% I'll allocate in anticipation zone itself. I won't wait for the breakout of the range. I will simply put my 5% there with an assumption that in next few days the stock will break out. Okay, now let's say in next few days stock breaks out. Okay, well, good enough. I'll allocate rest of my 15% allocation in that stock. Okay, but if stock doesn't did well, let's say it just drifted for 7, 8, 10 days, I will simply exit, and max I will lose my, my only stuck amount was 5% of my allocation. And if a stock went down and it hit my stop loss, then I'm happy, because in that case the stock, kind of told me that the stock was not ready and it hit my stop loss, and the stop loss was only on 5% of allocation, which will be very minimal. Okay, so the same approach you can also use to size your position. Okay, so let's pause now. We have did a great discussion on entries. We have pretty much identified which setup works well. We have also discussed a lot 3 entry zones. So one is anticipation. Second, we discussed about the range breakout, and third one was obvious base breakout. Okay. Now this entire framework which we discussed today is pretty much incomplete if we won't talk about risk management and stop loss. So the next few videos would be dedicated to that, and we also try to discuss how important this mindset and discipline side of it is. Okay, so I'll see you in the next one. Bye and take care.